So monitoring involves monitoring of both model inputs as well as model output. So PD model or LGD model or EAD model are basically the structural models or the statistical models which have model inputs, and when the model estimates are used, you get the model outputs, whether it's PD, whether it's LGD, whether it's EAD. So we need to monitor both inputs as well as output, and there are differences. Okay, the way you monitor inputs is different from the way you monitor outputs. We will use quantitative test as well as qualitative test to monitor these models, and we'll also use parametric test and non-parametric test. Often this is an choice. This is a choice that you have to make whether to go for parametric test or non-parametric. There are also regulations, regulatory mandatory tests that you need to follow, and you need to actually check the Basel documents to see which tests are mandated. But for understanding purpose, I'll explain both the parametric test as well as non-parametric test. Well, the parametric tests are basically tests where you have a statistical assumption such as normality and so on, and we assume certain type of distribution of the underlying data, such as normal distribution or binomial distribution, and so on. So t-test is a classic example of a parametric test, okay, where we assume certain distribution of the underlying data for which we are using the t-test. Non-parametric tests do not involve any sort of statistical distribution. There is no assumption of statistical distribution in the non-parametric tests. So that's the basic difference. Both can be used for monitoring purpose. Some are better than the other given the situations, and we need to understand that properly. We need to check the representativeness of risk driver. So a model, let's say, was built in 2011, and it's been there in production for the last 5 years, and let's say we are already in 2016. So we need to see whether the risk drivers or the input variables which were used in the model development in 2011 are exactly the same, as being the distribution has remained same, or there is difference, or there is a change in the distribution. So that's what we call it as representative. That means whether the current data is representative of the development sample data. Okay, so that needs to be evaluated. So it actually helps in knowing if the portfolio is changing over time. So if the portfolio is changing over time, then the old model is actually not good and it has to be retired. The model has to retire. So we should perform certain kind of a test to see whether the portfolio has changed its behavior over these last 5 years or not. And the way we do is we use PSI test. So basically calculate the PSI, which stands for Population Stability Index, and then we compute these values using the development data sample and the current data sample, and we see actually whether there is a significant shift in the distribution of the data. Okay, the way we calculate is, okay, here you see actual percent, expected percentage, but you simply can replace that with, let's say, this is development and this is current data. Okay, and you basically divide the sample into 10 deciles and then you compute this one. Okay, it's as simple as that. And the PSI value, if it is less than 0.1, which is 10%, then it is good. If it lies between 10% to 25%, then it is medium, it is okay, but still there is some issue. And if it is greater than 25%, then it's bad. That means there is a serious concern. Okay, and the way you write about it in the documentation, the way you represent it is presented to the management is traffic lights. So this could be okay traffic lights, okay, this could be somewhat not okay, and this is very bad. So we could use green, amber, and red traffic lights respectively. The next test is about monitoring granularity of the portfolio. So granularity is basically to test whether the portfolio is well diversified or not. If the portfolio is concentrated on certain types of clients, then we run a risk of concentration risk. Okay, and this actually happened during the 2008 crisis, where in many banks the exposure was mostly in mortgage. In the there's a big exposure towards mortgage and mostly subprime mortgage. And when those clients defaulted on the loan, the financial system crashed. Okay, and the banks just couldn't, like many of the banks, such as Lehman Brothers, Fannie Mae, and these banks had a strong exposure towards subprime mortgages because they were heavily concentrated in that kind of clients. So granularity assessment is very important from that point of view, where we actually see whether the portfolio is highly concentrated or not. What happens is that sometimes the concentration may increase, and which could be a business strategy, so which is a qualitative decision as well. So qualitatively we can say that the bank, financial institution wants to concentrate on a certain type of clients, which might be okay given the given the management strategy, or given the future strategy of the bank. But this has to be reported, and this has to be written down somewhere that this is the strategy of the bank. But otherwise you need to compute what is known as the HHI value, the Herfindahl-Hirschman index, HHI. And the way you compute is that you simply sum the squares of the the segments, so percentage of segment. It's pretty easy. If there are, let's say, n number of segments in portfolio, take the percentage of their presence in the portfolio, square it up, and then just add them, and you will get the HHI value. Similar to PSI, if it is less than 10%, it is good. If between 10% to 25%, then it is okay, but not so good. And if it is greater than 25%, then there is a strong concentration, okay, which is a red signal, okay, and this has to be reported. Then we see the stability of risk drivers. So when we mean by risk drivers, so risk driver is basically the input variables to any of these credit models, right? So the way we judge whether the risk drivers are stable is to re-estimate the model every year. So what we do is that, okay, so how does a regression model look like, right? We have a dependent variable and we have a set of independent variables, right? Or we call them as risk driver. Okay, let's assume that we have x1 and x2 as risk driver, which are predicting y. So we need to re-estimate this model using the new data, just to see how many of these estimates, beta 1, beta 2, beta 3, and so on, are actually significant now. It could be that with change in time, some of the estimates are no more significant, and then we call the model as unstable, or the risk drivers are unstable. If there is a significant number of risk drivers which are no more significant, I mean they are insignificant in the estimation process, then the model is unstable. Okay. Then correlation among risk drivers. That's one important test that needs to be done, just to see whether the risk drivers are highly correlated among themselves. At the time of model development, this would have already been taken care of, that we only use the risk drivers which are not correlated among themselves, because otherwise that causes a severe problem in the estimation process. Your beta parameters, your parameters, model parameters are not going to be stable if the risk drivers or the input variables are highly correlated among themselves. However, with time, this might change. That's why we need to continuously monitor this. We need to continuously, like for every year, compute the correlation between the risk drivers and see if there is a strong correlation. Correlation of greater than 5 could be a red signal. So anything less than 5 is still okay. But you also need to see what the regulation says. If the regulatory guidelines, simply follow them. But a strong correlation has to be reported in the monitoring document, because this would have a strong influence in the model performance. If the risk drivers are highly correlated among themselves, then the performance of the models might go down. Then we need to also monitor the model methodology and assumptions. Okay, model methodologies should be evaluated if they're okay and up to date with the changing regulations, with the changing business strategy, business and economic situations, or even for that matter the sample size or the portfolio size. With time it might change, and one type of model shouldn't be or cannot be used if the type of portfolio has changed since the model was last developed. What happens is that sometimes for a new portfolio you will have a small number of defaults sometimes, and then you go for a low default model, export based low default model, but over time you would have, let's say, more number of defaults, a sufficient number of default. Then you cannot use the export based low default portfolio model. You rather have to go for high default portfolio model, and therefore this particular test is so important. This is a qualitative test where you do not perform any quantitative test. You do not compute any quantitative estimate to come up with the traffic lights. You actually judge through expert judgment, through your domain expertise, your expertise in statistical modeling and so on. And then you actually evaluate whether the model needs to retire or the model can be used for more years. So this decision has to be made through qualitative judgment. Then the next one is monitoring the model output. Okay, and the model output in such case could be PD, LGD, and EAD. Right? We saw how to monitor the model inputs or the risk drivers. Now we just see how to monitor the output, which the output of model risk models are PD, LGD, EAD. Right? So the reason why we monitor the model output is to actually see if the model is still correct representation of the world. Otherwise, it has to retire. So it's basically to ensure that the model is able to distinguish good, the low risk clients from the high risk clients. If the model is not able to discriminate that, the model is a bad model. So a bad customer should get a high PD, his PD should be high, and a good customer PD should be low. So that should be the essence. Similarly, for a highly risky client, the LGD should be more, and for less risky client, the LGD should be less. Right? So that's what we really want to monitor, if the model outputs are exactly what we actually expect them to be. So we basically monitor the ratings. So as you know, PD are basically not the probability, rather they're converted into different rating grades. Right? That's how we use the PDs in the real world scenario. And to monitor the PDs, we actually test the representativeness the way we did for input variables. We compute the PSI values, and the thresholds are exactly the same. Anything less than 10%, it's still fine. 10% to 25% is okay, but not so fine. There's still some room for improvement, but anything above 25% is a serious concern. The second one is concentration. Pretty much the way you compute for input variables, we also need to compute for the output of the model, which is through HHI. So thresholds are exactly same as the input variables. And for PD, we need to compute PSI and HHI, and we need to do it for segment wise and bucket wise. What do we mean by that? Segment wise could be a different business unit level. Okay, with this you need to compute them and see if it actually performs bad for a given business unit. And then bucket wise is basically you have many rating buckets. Let's say you have A, B, C, D. You compute the PSI value for each bucket. That will give you a more granular picture or more detailed or deeper picture of the portfolio distribution, whether the model is actually fit for use or not. So that's important. For LGD, a PSI value is enough. You need to just compute the PSI value to see whether there is a significant shift in the distribution of the LGD over time. And this can also be done for segment wise. In fact, this should be done for segment wise and for bucket wise. Then we do the discriminatory power, which is one of the most important, perhaps the most important test to evaluate the model performance. Well, the discriminatory power test analyzes the model's ability to distinguish good and bad clients. Okay, and the way we compute, we measure the discriminatory power of the model is to compute the Gini for PD models and Spearman rank correlation for the LGD model. Okay, so we can use the Gini statistics in order to see if the PD model is performing good. So the Gini should be good enough to confirm us the model is performing good, or the model is able to discriminate good from the bad clients. And Spearman rank correlation is used for LGD, which gives us an indication that the model is able to discriminate high LGD for highly risky clients, low LGD for lower risky clients. The thing that we'll see is how to backtest PD models. As I have said, backtesting is also part of monitoring, except the fact that it's basically done or intended for the default clients. So here is an example. You have, let's assume that we have 4 rating buckets, A, B, C, D, and there are different number of observations. Like we have 1000 observation, 1000 default clients in rating bucket 1. In rating bucket 2, it is 800, in C 700, in D 1200. So we compute the average PD in each bucket, and we compute the actual default that happened in these buckets. Okay, let me correct myself. The n is not the number of defaults, is rather the number of samples. Okay, the total number of observations or total number of clients in that given bucket A. Default is here. Okay, the number of defaults is here right next to this one. So in this column we have the number of defaults, and you compute what is known as the observed default rate, which is simply 22 divided by 1000. Number of defaults divided by total number of observations. 2.2% here. So this is the predicted average of PD, 2%. The actual average is 2.2%. For the rating bucket B, it is 1.5%. Here it is 1.25%. So we basically need to see how close the expected default is, or the predicted default is, to the actual default rate, or how the average PD is similar to the average ODR. And the way we do it, there are many ways to do is we can use the chi-square test. We can use the binomial test as well in order to arrive at a conclusion whether the model is performing well. That means they should be similar, right? If there is a strong difference between the average predicted PD and the average observed default rate, then the model is not able to predict default properly. Okay, so they should be pretty close. The idea of using chi-square and binomial test is to see whether they are similar, very close to each other, or there is a strong difference or significant difference between the average PD and the average ODR. Similarly, we can also do backtesting for LGD and PAD. We can use paired t-test for that, and the hypothesis is like the realized average LGD minus the predicted average LGD should be 0 or should be very insignificant value. And the alternate hypothesis is that they're not equal and there is a significant difference. Okay, and we can use the paired t-test in order to arrive at a conclusion whether realized average PD is similar to the predicted average PD. So we can do it for entire portfolio, and we can also do it for different segments. There are also other tests that needs to be done apart from what we have discussed so far. We can also test, or in fact we should test, the data quality is the most important thing, because the data quality over years has changed or not. If it has, then there is a serious concern the way we use the model, and that has to be evaluated properly. Correct implementation and usage, we should evaluate every year. That would be a proper monitoring of model implementation, whether the model has been implemented properly and is being used properly by the users. That needs to be monitored. It's a qualitative test. And then override percentage, just to see whether, so what I mean by override is that if the model output has been overridden by expert judgment, now that's a, you know, that's a sign of a poor performance of models. If there is a strong override percentage, anything above 10% is a serious concern. Then you need to see if why the model is not performing. Okay, and then that gives a signal that the model is not performing very well, because experts are not relying on the model output, rather they are relying more on the expert judgment. So the model needs to be rebuilt or recalibrated. Similarly, regulatory compliance, right? Regulatory compliance is very important because regulations do change over time. It could be, default definition, or it could be model methodology, or it could be regulations, the way we compute all kinds of things, right? Whether it's like, downturn your calculations, or whether it's default definitions, or what kind of models that you should be using and such stuff. So monitoring should be done to see if the current models are compliant as per the latest regulations. So that's about how to monitor credit risk models. If you really want to learn credit risk modeling, please write to us. This is our email ID. Thank you.